Welcome to our budget live stream, and I'm just going to briefly summarize my take on what this budget means for us as investors in the UK, but also for the economy and whether it's achieved its goals, because I think that's really the interesting part. Now, at the end, there'll be questions, so please do ask a question at the end. And of course, as usual, if you're one of our supporters on YouTube, we'll push you to the front of the queue. And if you do a super chat, of course, we'll push you to the front of the queue. So let me just start with my take on it, because I think I found this quite disappointing as a budget, because remember that the policy of this government is to achieve growth. And yet, if we actually look at the OBR's forecast for what's going to happen as a result of these policies, they forecast very little change in growth, which was completely unsurprising given the scope of the increased spending which this government's decided to implement. Now, to a certain extent, yes, you've got to be responsible. You can't spend too much. The bond vigilantes will punish you if you do. But I think what's clear from the market reaction to the budget is that markets could have quite easily absorbed a much more ambitious set of spending rules and policies, and that would have been much more stimulative for growth. I think the actual policies themselves are interesting, good. I think they will achieve some growth, but I think it's not as ambitious as it could have been. And I think given this is the first budget of this parliament, of this government, the first one from a Labour government for 14 years, I think really it's underwhelmed and they should have gone in harder. So that's my take on it, and we'll talk about the details now, and let's just see what the Office for Budget Responsibility said. But I think you might agree with me by the end of it. Look, if you don't, just tell me in the comments at the end. So let's just start off with the actual a quick run through of what changed, what didn't. I'm sure you've seen this in the press as well, so I'm not going to labour these points, but we'll just kind of rattle through. So let's start off with what didn't change. So there were some worries that we were going to have a really punitive change to the tax rules. Well, that didn't happen when it comes to pensions. So you've still got the 25% tax-free lump sum up to a maximum of 268k when you retire. So they haven't touched that. ISAs, many people were saying, oh, maybe they're going to cap ISAs. There'll be a lifetime limit on ISAs at 100k. This was something mooted by the Resolution Foundation. Or they changed the limits on how much you could put in every year. Well, no, none of that. And they actually kept the venture capital trusts in place, the enterprise investment schemes. All of that's been extended to 2035. So after you've filled up your ISA, your SIP, you've still got those two ways to invest in British businesses, because this is a business-friendly government and capital becomes available to small UK companies which help UK growth. So those schemes are very growth positive. And by giving tax breaks, the government is essentially making that capital readily available for small UK startups. So that's all stayed. Inheritance tax thresholds, many people thought there'd be a massive raid on inheritance tax. There have been some changes, but overall the thresholds have been frozen up to 2030. Now, freezing the thresholds, of course, doesn't mean that we won't pay more tax, far from it, because with fiscal drag, as you get greater wealth over time, you have to inflation adjust things in order to not have to pay more. So as all of us get more wealthy over time on average, then we're going to have to pay more inheritance tax over time. And by freezing those thresholds, we're going to pay more. So no huge changes there, I don't think. And certainly the way the government telegraphed it as being something really worrying. Many clients I've spoken to were really worried about this budget. Well, I think that was a mistake in signalling. It just made people pissed off and miserable. And but let's look at what actually did change. The first one, I think, is there were some changes to capital gains tax. So the lower rates increased from 10% to 18%, higher rate from 20 to 24. Now, many people I spoke to had already sold stuff. This tax will change immediately today. So any disposals you've done today or afterwards will be affected by this increase. So if you miss the boat, well, it's too late now. Residential property, the capital gains tax is unchanged. So this is far from a draconian raid. It's an incremental increase in the rates, but not a huge increase for the higher rate, for example. So if I'd have sold all of my stocks, which had made a profit, I'd be kind of kicking myself, I think, given the fairly modest size of the increase. Some people were talking about increasing it up to, say, 45% to be in line with the highest rate of income tax, but it's nowhere near that. If we look at the AIM market, because one of the beautiful things about AIM, it used to be with this, if you bought UK small cap stocks from the alternative investment market, which is like a separate exchange for small cap startups in the UK, there'd be no inheritance tax on those stocks. Well, now you're going to have to pay 20% inheritance tax. So many people thought this would completely sink the AIM market. But in fact, there was a sign of relief from the AIM market. So you can see the actual, the budget started at 12:30. And as soon as we heard about the AIM tax change, this is the actual quote from Rachel Reeves, you can see that the market shot up 4%. Now, this is a very volatile market. If we zoom out, this is like 5 days of returns on the AIM market. If we zoom out, you can see that tiny change compared to how volatile the market is anyway. That's been a market that's been performing very poorly long term. So this isn't a market I'd invest in personally, but you can see that the tax break didn't, first of all, sink the market. In fact, there was a bit of relief about the size of the tax, just 20%. So that was a fairly small change, I'd say, and it didn't have a huge market impact. In fact, it was a bit of a relief. Another tax which most people wouldn't be aware of or even care about is for carried interest. Now, this is primarily for private equity funds. So it affects very few people in the UK. It affects some very wealthy people in the UK, some of whom are our clients. And the idea with carried interest is that if a fund makes a profit, a private equity fund, then they don't have to pay the very high income tax rate. Usually these are additional rate taxpayers of 45%. They instead pay capital gains tax on it. So this dates back to the 16th century, in fact, which I thought was an interesting factoid. It was actually the profit share given to a ship's captain, and it was a tax they had to pay on that. So it's called carried interest. But this rate is going to increase from 28 to 32%, and there are further reforms to come. So it was treated as it was referred to as a tax loophole, and there were worries that it was going to be scrapped altogether, but that didn't happen because they realised, I think, that it wouldn't have raised much revenue anyway. The stamp duty surcharge. So if you have a second home in England or Northern Ireland, the second house that you sell, the stamp duty surcharge has gone up from 3% to 5%. So that's additional to the stamp duty you'd usually pay. So that's increased. So again, this is about making people who are more wealthy pay more tax. So that's all in line with the kind of political goals of Labour, which is to favour the poorer members of society rather than the more wealthy ones. The big change, I guess, the one which is going to raise 24 billion out of the 40 billion extra income in tax, is increasing national insurance contributions, increasing the tax paid on national insurance contributions. So previously, employers would pay 13.8% above a threshold of 9.1k. Now it's going to increase to 15%, and the thresholds come way down to 5,000 a year. So 25 billion a year, and they're not going to charge NI on pension contributions from the employer. So people were saying that would happen. In fact, that didn't. So these are the changes which we've seen. And, overall, if I had to summarize them, I'd say that, is it catastrophically bad for most people? I don't think so. Capital gains tax is going to hurt some people. Certainly some of our clients will be hurt by that. But overall, I don't think it's anywhere near as bad as was painted by the Labour Party before the budget was actually announced. So a messaging misfire, I think, from them on for this budget. Now let's quickly look at the market impact, because I think that's what really shows that they didn't go hard enough. Let me just close that. Yeah, so market impact. So if you look at the 10-year gilt in the UK, so this is TS34, I think, is its ticker. So this is the 10-year gilt. It's what most people talk about when they talk about government debt. It's the 10-year. Now the price of that fell, you can see during the course of today, by around 1%. So if you use the duration of that bond, which is 8 years, that tells you that the yield went up 0.13%, which is a very small change, right? So I was hoping this would be an opportunity to fill my boots with gilts. Unfortunately, that hasn't happened. So these fiscal rules have really spoiled the gilt party, which I was hoping would take place, where I could snap up gilts at discount prices. Sadly not. So markets effectively reacted very little. The key market we should be looking at, of course, is the debt market in the UK, the price of gilts, and the reaction was fairly muted, which I think signals that they haven't done enough. They could have spent more, and the way they signalled it, which is to be very prudent, is good, but I think they could have taken it further. Sterling, another very good short-term indicator of stress in the UK economy, or economic stress. Remember, this sold off with the trust budget. Really not much happened. There was a bit of volatility, but if you look at the daily volatility of sterling versus the dollar, it's not a huge move. So overall flat on the day and not a big move. So markets really took this in their stride. It was pretty much under, people expected what was announced because of leaks, maybe accidental leaks, maybe not, but overall not a big reaction at all. And the FTSE 350, really, if there hadn't been a budget, you wouldn't be able to tell. So hardly any effect on the UK stock market at all. So now let's turn to the economic impact, which is of course the really big one, and the one which is I think quite disappointing. Now this is all based on OBR forecast, the Office for Budget Responsibility, which now has a much more important role to play in terms of making policy. This is the kind of disappointing graph, I think, which shows their forecast for GDP over the next, over the investment horizon, over the forecast horizon, which goes out to 2030. Now, this is relative to a baseline, which is before the budget. So what effect will the policy have on GDP? Now, the diamonds here show you the overall effect, and then the individual shaded bars show you the positive and negative effects, the contributions to that overall effect. So over the course of this year, it's all about increasing the demand. And then you get a big jump up in demand in the first year. Well, I say big, it's 0.6 percentage points increase. And then you start to get that fade away, the initial increase in demand, because the government is spending more. Fiscal stimulus creates demand. The government's spending more, that injects money into the economy. Every pound that's injected into the economy gets spent multiple times. So that's what we call the multiplier effect. But that gradually fades over time. And then we get these secondary effects, which are negative and more longer lasting. So the yellow one is that increase in employer national insurance contributions. Now, what was interesting is according to the Office for Budget Responsibility, according to their model, the way they work out the effect of that NIC contribution is to say, Well, what proportion of it is going to get fed through to lower wages for employees? And they think 3/4 of the national insurance contribution, national insurance tax increase will be passed on to employees. And the remaining quarter will simply be absorbed by the company and reduce their margin. So I think overall, it's pretty shocking because it means that we'll be poorer, we'll have less money to spend, and this tax that was supposedly on companies was an illusion. Economists would have told you that anyway, and that in fact we'll end up paying the national insurance increase anyway, and a quarter of it is just going to make the companies less profitable in the UK. So that's the kind of longer term drag on growth that you can see here. The yellow NIC, employer NIC effect. And then we've got the kind of crowding out effect, where if the government's spending more, then private companies will not spend money on infrastructure and business development, for example. So far from being what the Labour was saying would happen, which is if the government spends more, then they'll get crowding in effects where the private sector will also spend more. This suggests there's some kind of crowding out effect where it's actually going to be a drag on growth. So that's kind of disappointing. And overall, you can see that the kind of growth that you can see there is quite negative. So initially you get a boost, but then by the year 28, 29, 29, 30, the effect is pretty much gone. And overall, the effect is negligible. So not a huge boost to growth at all. 0.6 percentage points is not something to get excited about. But given the size of the increase in spending, I think that's not altogether surprising. So let me just read out to you from what the Office for Budget Responsibility said. We assume that around 3/4 of the cost is eventually passed on to employees through lower real wages, and employers are going to will pay the remaining quarter by lower profits. And the net fiscal loosening provides a temporary boost to demand, which raises GDP by slightly over 0.5% at its peak impact next year. So not really very exciting at all, unfortunately. So now let's move to inflation, because that's obviously another thing that went badly wrong with the Kwarteng budget. This also will be slightly inflationary. So just to show you how to read this, the October forecast is the kind of, is that blue? That blue line here. And then the dashed line is the pre-measures forecast without this set of policies. So not a huge effect. Under the previous March budget from Jeremy Hunt, you can see that inflation would have been falling below the 2% target. Now we're going to increase slightly above, maybe not quite reach 3%, and then head back down. So slightly inflationary budget, but not huge and not irresponsible like the Kwarteng Trust budget overall. The thing which I think will upset people, particularly if you're a borrower, is the forecast on yields. Now, bank rate, which is the central bank's policy rate, the expectation now is that due to that higher inflation, and that itself is a result of the size of the fiscal stimulus being larger than markets expected, that's going to actually be higher than it would have been under the Conservatives. So by about 1/4 percentage point, I think, or 0.5 percentage point. So if you're expecting your mortgage to go back to 1%, well, not going to happen. Previously it wouldn't have happened anyway, but in fact it's going to be slightly higher than it would have been, but the effect is fairly small. Now, what actually sets your fixed mortgage rates will be closer related to the gilt yield, because what actually sets these fixed rates is the swap rate, which is roughly equal to the 5-year gilt yield, and that's actually forecast to increase over this investment horizon. It'll fall slightly towards 2025, but then slowly increase again because of this unexpected size of fiscal stimulus. So overall, it could get more expensive with your mortgage over the next 2 or 3 years, assuming this forecast is correct. So not good news if you're a borrower. If you invest in gilts, as I do, that's kind of okay. I expected there'd be more of an opportunity with gilts, as markets were shocked by the amount of issuance there'd be, but in fact it's been a bit of a damp squib for the gilt market as well. What is it going to do to debt? Now, what's interesting is that, of course, Rachel Reeves has changed the definition of the target for their debt effects. So we've changed from what the Conservatives had, which was public sector net debt, excluding the Bank of England's holdings and losses. We've changed to something called per snuffle. So we'll talk about that in a moment. But you can see that, yes, it's not going to have a huge impact on debt to GDP, but it will increase debt to GDP initially, but then, of course, by the end of the 5-year forecast, it's going to come back down. That's, of course, the goal. But we're going to use this per snuffle measure from now on. Labour is going to use that. That's the green line. Notice that's considerably lower than the previous measure, which was used by the Conservatives. And that's in order to give them more fiscal room to spend, although by the look of the budget, they didn't really use it. So remember that this fiscal headroom is really important for a Chancellor. The definition is based on the forecast. What's the difference between government income and government expenditure? Now, the bigger that gap is, the more, if you have lots of income and not much expenditure, you've got more wiggle room to spend. So really this tells you how much the Chancellor can spend in order to stimulate the economy. The more fiscal headroom there's going to be, the greater the capacity to stimulate the economy. So what makes it larger? Well, if growth is larger, then GDP ultimately generates taxes. More GDP means more taxes, and that increases headroom. So if this does stimulate growth, in theory, there should be greater fiscal headroom down the road. If taxes increase, that increases headroom as well, as long as it doesn't stifle growth. If spending increases, headroom goes down. If gilt yields increase, we have to spend more servicing our debt, and the headroom goes down. So this is the way that works. And what's pretty interesting is that if you actually look at Reeves's fiscal headroom, she has very little indeed. And one of the things that the OBR was stressing is that there are lots of risks when we come to review this budget in a year's time, that they're planning, for example, to increase the government's defence spending to 2.5% of GDP. That's going to be very expensive, and there's not going to be much wiggle room to do that. Plus, things like the health service always tend to cost more over time. And if interest rates increase, they have to spend more servicing the debt. If growth underwhelms, then they're not going to have enough tax revenue to, the size of this fiscal headroom will shrink further. So there are lots of things that could happen to make this fiscal headroom get eroded to nothing. So there's very little wiggle room. But look, we were in a difficult place. Rachel Reeves had a very difficult job creating this budget in order to meet her own self-imposed fiscal targets. So now let me end by just quickly showing you these debt measures, because I think that's kind of important. Now, previously what we had was public sector net debt. So that was financial liabilities, so that's the stuff that you owe as a government, primarily your debt, government debt, minus your liquid assets. Liquid assets are stuff that you can sell quickly if there's a fiscal emergency. For example, your foreign exchange reserves, there's an account called the Treasury Reserve that could also be raided very quickly in order to spend. It doesn't include illiquid assets, things like roads, school buildings, army barracks, because you can't sell those and they don't generate revenue. So it's really about stuff which is liquid. But we're moving away from this measure, and instead we're using something called per snuffle. And Teddy very kindly posed for me earlier just to demonstrate a bit of snuffling. But it's not what you think. It's not about snuffling. It's about public sector net financial liabilities. what this means is you subtract more stuff. So now instead of just looking at liquid assets, we look at broadly financial assets. So that could be student loans, for example, which are illiquid, they're tricky to sell. It could be stakes in financial institutions like NatWest, a much broader definition. The logic behind this is that if you're going to spend, you don't just think about the debt, you think about the assets which generate an income for the economy. And of course, student loans do generate an income. An investment in NatWest, in theory, could be quite profitable and it might generate dividends, for example. So if you are going to spend on things which are positive for growth and which could actually generate some revenue for the government. So these are the definitions. This is what I think is really useful. This is from the Institute for Fiscal Studies, and they've got various definitions of debt here. And the one which we're now using is per snuffle. That's the middle one here. And you can see that this includes liquid financial assets and illiquid financial assets like student loans. Mark Carney, the previous Bank of England governor, suggested something like public sector net worth, although that would have been very dodgy because it would include things like, all of the wealth in the UK, which would be very difficult to measure and also to value. So instead, the government's gone for per snuffle as a kind of middle road. But the primary reason for doing this, remember, was that so that they could reduce the overall debt to whatever debt measure they've got. They could reduce the overall debt amount because they're writing off the assets against it. So again, if you were cynical, you could say, well, the only reason they did this was in order to make it easier to issue debt and to change the goalposts by fiddling the books in order to be able to spend more. And that's kind of true, unfortunately. But I'd argue that actually this is a better measure because these growth generating assets do make more sense to spend on. So instead of issuing debt to pay for things which don't generate growth, it kind of forces the government to focus on growth generating investments. And another point that was made, which I just saw this tweet today, I'll just finish with this before we go to questions and invite Teddy up for a snack. He's going to snuffle a snack. I haven't got many left, actually. This was actually a tweet by John Byrne Murdoch. If you don't follow him on X, you really should. But his point is that tax burdens are at or near record highs in almost all countries. Why is that? Well, we all have aging populations and healthcare costs a lot. So you would expect tax burdens to increase over time because you have to pay for health. Unless you're the US, of course, in which case it's done privately. Whereas in almost every other country in the world, except for South Africa, I think, we have a public health system. So it's hardly surprising that tax burdens are at or near record highs in the UK. It's a universal feature that we see across the world. So I hope that was helpful in terms of kind of going through what the budget says. Personally, I don't have any investments outside my ISA or my SIP, so the capital gains tax hasn't really affected me. The sale of our business, if we ever decided to sell PensionCraft, the tax has gone up on that, although not hugely. So overall, I think it wasn't anywhere near as bad as Labour was suggesting. And I think they kind of misrepresented it as being an awful budget, where really it wasn't. It wasn't that painful at all. But in terms of growth, I just find it quite disappointing. I think they could have done much more. And the market reaction shows us that. There's hardly any market reaction at all. So let me just stop there. You ask some questions and I shall summon my cockapoo Teddy. And hopefully he'll appear. And I'll need to rattle this box because that brings him up the stairs. Here he comes. Come on, Ted. Come on, I can have one of these treats. Come on, Ted. Dogs are supposed to be loyal, mate. It's not just about built on. There's a good boy. Very good. One more. Snuffle that treat. Yes. Good boy. There we are. Enjoyed that? So you're going to go and get some biltong downstairs? Yes, he is. He's listening for Laura's whistle. Yes, he's going down. Brilliant. Yeah, so super chats. Please do super chat if you... please do super chat if you want to ask a question. We'll push you to the front of the queue. Or if you're one of our supporters on YouTube as well. Please do like and share. I should have said that at the beginning, shouldn't I? Always forget. Laura will tell me off. Right, so let's have a look at questions. Oh, incidentally, I won an award. Look. This is the Finfluencer Award for Best Economist. There we are. Thank you, Finfluencer, for that. That was great. The most interesting thing about it actually was going to London and meeting all the other influencers. I didn't realise there were so many, and many of them I hadn't seen before or didn't know about, which was interesting. That was great. Right. Questions. Dominic Rowe says, looking forward to this one. I hope I didn't disappoint you, Dominic. And Night Train 123 says, could have been worse for us pension savers. Yes, it could. I didn't think it was that bad at all. Carey Tim 60 says, inheritance tax liabilities now come to the fore for anyone dying with a defined pension pot. Perhaps a trust will be a better option. I think for the inheritance of SIPs, it was ridiculously generous beforehand. So the fact that you could just hand over an undrawn down pension to your kids and pay not a penny of inheritance tax, that was ridiculously generous. And it did increase generational wealth disproportionately and increase inequality. So I think having that as part of the inheritance pot actually makes sense. I think that makes sense. I don't have any big issue with that at all. And I can't switch off Matmos. That's interesting. Okay. So yeah, I wasn't that kind of horrified by that change. So I think probably what people will do now is just spend their pot. More of them will spend their pot on themselves. So sorry, kids, but it's just tax inefficient to hand it to you. I've got to go on this cruise. Terrible. Johnny123. Yes, Johnny123 says, on the surface it looks like savers got off lightly, but what are we missing which might be hidden? Interesting. I don't think there is that much hidden, to be honest. I think most of us use ISAs and SIPs, and those haven't hugely been affected. On the way in, the amounts are the same. The tax breaks are the same. On the way out, it's pretty much the same. It's exactly the same. Maybe they'll change it in their second budget next year, but at the moment it looks like they're not going to fiddle with it. And it does cause huge problems, I think, when people do fiddle with the pension system, because it takes so long to implement, and people have planned for their whole, career on a certain set of tax rules, and then you suddenly change the goalpost just before they retire. Well, that's not going to do much for your chances of getting re-elected. So I think that's the problem, and I think that's why they're loath to change things like the pension system, because if you do, it causes so much hatred and probably doesn't raise that much in terms of revenue. So the inheritance of pensions, that's going to be a big change, I guess. But this is more to do with the problem with allowing no inheritance tax on pensions when you hand them over to your kids is that what it encourages is unproductive use of your capital, because you're trying to save as much as you can until you die. And all of that capital could be better used if you'd spent it on something in the interim. So by hoarding capital that way, I think it becomes unproductive for the economy. So it's not necessarily a good thing. So I think that bringing forward consumption, spending your pension pot is a better use of the pensions and what they're designed for after all, which is to be able to have some kind of retirement. Previously, we didn't have retirement. We just had to die on the job. But, having that 20 years at the end of your life, when you can actually spend some time doing what you want to do, I think is a great privilege. El Sabio says employers got hit hard. That will be passed on in terms of higher prices and or fewer jobs. Yeah, in fact, that's exactly what the OBR said. They said that it would decrease the employment. Let me just see if I can find it. I think it's 50,000 jobs. 50,000 national insurance. Oh no, that's Rachel Reeves. Wrong one. Give me just 1 second. I've got the transcript here. Yeah, here we go. So they assumed that the increase in national insurance employer national insurance contributions will reduce employment by around 50,000 and potential output by around 0.1 percentage points. So a fairly big decrease in employment, 50,000 jobs, because if an employer has to pay more for an employee, then presumably they'll consider whether they should hire another person if they become more expensive to hire. For small businesses, of course, the thresholds mean that many businesses won't have to pay NI contributions. Some of them which are currently paying won't have to pay at all. And remember, a lot of the growth comes from small and medium-sized companies. So that relief actually could be quite positive. But I didn't see a mention of that from the OBR. But anyway, yeah, your point's a good one, which is the NI contributions are likely to reduce employment. Any super chats? No. Okay. D says, thank you for your thoughts. Thank you. Employers got hit hard. Do growth projections include potential boost of a better funded, functioning NHS? NHS cuts have been the ultimate false economy, with millions on long-term sick leave. I think that's right. I think you've got to think about these models, and it's very difficult to predict these second-round effects. There's only so much complexity built into the model. So putting too much faith into the OBR, I think, is a mistake. At best, it can give you a rough direction of travel. Talking about percentage points here and there, I think, is kind of not helpful and unrealistic. There's no way the model could be that predictive, because there are so many other factors which could drive growth, inflation, and GDP. It's just got so many drivers other than the policies which the government's come up with. So really it's changes to the base case which we're talking about here. But you're right, I think having a better funded NHS, better infrastructure, fixing potholes, better education. Rachel Reeves was telling the story about how in her sixth form she had to, her sixth form block was just 2 porta cabins on her school playground. And the reason why she went into politics was to correct that, to try and make it better for the next generation, which I think is admirable. But if we do have really awful infrastructure, you're right, I think it's a problem for growth. So that could be quite positive. And that's not looked after, that's not kind of taken into account by the OBR models. She didn't mention fibre to the premises, which I'm desperately hoping comes to Holmer Green. but maybe she will talk about that later on as part of some other spending package. What do you think of this analysis from Chris Dillow? The fact that higher employers NIC will destroy jobs is a feature, not a bug. Okay. The government needs to reallocate labour from private to public sector. Well, I think having a big private sector, well, we've already got a pretty big public sector in the UK already. But is that going to have a huge positive effect, moving more people into the public sector? I'm not convinced it would have a huge effect. No, I'm not sure I kind of agree with that, with Chris Dillow. But I'm not sure what the logic would be there, that people would be more productive if they're in the public sector than they are in the private sector. That's certainly difficult to understand if that's his point. How has your small cap portfolio performed today, Romin? It's not good. At the moment, it's been really plummeting. I did have a look at it this morning and it just didn't look good. So I've got a UK small cap value growth quality portfolio. And at the moment it's it says it's gone up a lot. I don't believe that. This morning it was awful. So maybe, I mean, one of the things was one of the stocks had a takeover and maybe the takeover's gone through. Not sure. But actually it looks like it's doing okay. Oh yeah, it's that one. Trading's been suspended. Corporate action under review. Okay, so that's it. Maybe that's... Oh yeah, it's gone up. Oh, it's gone up a lot. Okay, so that's good. But look, it was just luck. So it's gone up a bit. It's up about 7% since I bought it. So there we are. But look, I think the UK is cheap. I think that stocks do well despite governments rather than because of. But overall, this budget wouldn't be necessarily negative for UK stocks, I don't think. If it does achieve some growth, then yeah, that could be a positive. But obviously the NI contributions are another thing altogether, and that could be a drag on margins. It certainly wasn't a giveaway for UK companies, so it wouldn't surge upwards for small caps. But overall, not a big negative or positive impact for my portfolio. Thank you for asking. Ooh, a super chat. Thank you. Scipio Africanus. Yes. The Emperor returns. A friend of mine has allocated a significant portion of his ISA to gold, despite having a time horizon of 20 plus years. Is this sensible? Thanks as always. Yeah, I mean, many of these permanent portfolios, in other words, portfolios which are kind of simple but are designed to be fairly steady risers, which are diversified across asset types. So they've got stocks, bonds, commodities, maybe real estate investment trusts. These cross-asset portfolios, like the permanent portfolio, like the golden butterfly, which Tyler of Portfolio Charts has come up with, like the weird portfolio, which Value Stock Geek, a guy on X, came up with. All of these portfolios have a fair old slug of gold in them, some more than others. And if you actually look at the statistics on how well portfolios perform in retirement, a bit of gold helps. Not a lot necessarily. Some of these, like Harry Brown's permanent portfolio, has a quarter of the investment in gold. Huge. But I think having, 10% in gold, for those really awful situations where everything is falling, bonds and stocks, then the gold definitely provides a bit of a support in those kind of situations when people are really scared. But remember that if you actually look at the risk premium for various investments, For stocks, historically, it's been about 5%, 6% above inflation. For bonds, about 4% less. And then for gold, it just matches inflation. So there is no real premium. Another way of doing it, in fact, the video for this Saturday probably is going to be about how to invest in gold, because so many people are at the moment. Then if you buy gold miners, at least then you earn the risk premium for stocks, and usually you get a bit of dividend on top. So yeah, why not have some gold in your portfolio? But significant proportion covers a multitude of sins. How big is that significant proportion? If it was more than about, I don't know, 15%, I'd start to get a bit nervous, because gold is quite crashy in itself. It isn't a safe asset in that sense. It's very volatile. The key thing is that gold holds its value when every other asset is tanking. That's why it's valuable. But risk premium wise, it's just not great. And it does have these really long periods of drawdown. In fact, in real terms, it's still in drawdown from 1981. So I'm not a huge fan. But, I can see why people do buy it. And in retirement, I might, buy some gold, maybe. Certainly the back test suggests it's worthwhile. So back to your questions. How are we doing for time? We'll give it another 15 minutes. I didn't realise stamp duty policy was devolved. I didn't realise that actually either. Saurabh Sharma says, I was using my pension pot to pass on to my children. There goes that plan. Hey, Saurabh, spend it, mate. Spend it. Sorry, kids. That's going to be in our cruise holiday. We'll send you a postcard. It's funny, we're just speaking to people. Some people are desperate to leave money for their kids. Other people say, well, I provided them with a good upbringing, good education, so, I think that's where my responsibility ends. They've got good jobs. They don't need my money. That's often what I hear. Yeah. Night Train 123 says, I was worried pension changes would be more punitive. Yeah, you'd have thought this would be catastrophic based on what Labour was saying, but I agree, I don't think it was that bad at all. Mark Evans, Paul Johnson IFS, who we just interviewed for a podcast, he was very good. Paul Johnson, many happy returns, if you want to listen to it. Oh, and I can plug many happy returns, I always like doing that. Oh, not there. Many happy returns, many happy returns, many happy returns. Here we go. Many Happy Returns podcast. And so this was Paul Johnson from the IFS. And Paul was great. He won't be at the IFS for much longer. He's actually moved on. But he was a great interviewee. And the bit we liked best actually was at the end of the podcast when we did a quick fire round, and he's just brilliant. He came up with this stuff right off the top of his head. And we recently interviewed National Treasure David Spiegelhalter, the Bayesian statistician, and he's written a book called Chance, Risk and the Art of Uncertainty. And he was just great. He was just such fun to interview. And it turns out that a lot of the Bayesian principles are very applicable to investing. How do you decide what to do in an uncertain market? With tax uncertainty, with market uncertainty. And really Bayesian statistics provides a framework to think about how to make decisions, how to update your beliefs based on evidence. So yeah, I think he's great. Anyway, that was another podcast which we did recently with David. And Paul Johnson of the IFS says that NI rise won't raise 26 billion, more like 10 billion. And if it hurts jobs and growth more than expected, the net effect could be zero. Yeah, I think it's true. And I think it's true that that's possible. And I think that's why it's important to have more than one model. And yet, all we get from the OBR is a single view, which itself is a problem. And this is one of the conversations we had with David Spiegelhalter, which is, what do you do if you've got more than one model, like we did with COVID? How do you combine those models? And this is one of the pieces of research he did. So he came up with these frameworks of combining models. And the key thing is to have the uncertainty of the model built into it so that you know exactly how certain the model is. And then you can say, if you've got two models which are very different and the differences are outside the error bars, well, that tells you that the error bars aren't big enough. Because every model should actually consider the possibility that the model's assumptions are wrong, because they always are. So that was an interesting conversation. But I think that would be a better framework than just having the OBR do the forecast, which is that you just got one view. Someone says, BGMTS 17 says, the change to inheritance tax on pensions up to age 75 is major. I think it was too generous anyway. But yeah, I think it is a big change. But remember that most people don't have much in their pensions anyway, the vast majority of people in the UK. And that's the problem. That's why if they'd have really affected pension savings a lot, made it less attractive, for example, that would have been a huge issue. And I would have been very angry about that because it would have put people off saving. But they didn't do that, which is good. Primarily, pensions are for saving for yourself, not to increase your family's wealth. That's my view anyway. According to OBR, so MCS says, according to OBR, this was an anti-growth budget. I don't believe I read them saying that. I think you might want to check your notes there. To what extent is the spending really investment? HS2 perhaps? GB Energy is still empty of policy. Well, I mean, if you listen to their 7 pillars, I did make notes as Rachel Reeves was blathering on. Yeah, 7 pillars of growth. Here we go. Restore economic stability, which they kind of have. Increase investment and build new infrastructure. 70 billion to spend through the National Wealth Fund. A pretty small wealth fund, to be fair. But look, they're trying. Devolved governments and mayors' growth plans. That's good to have local governments decide how to spend money, because they've got a much better idea of how to do that than central government. So I think that's probably a positive. Skills England to make work pay and tackle economic inactivity. Yeah, all good stuff. Small and medium enterprises, favouring their growth. R&D to harness the science base. Yeah, that's good. Clean energy investment. Yeah, I'm up for that. Unfortunately, they've gone for carbon capture, which I think is probably not a great technology. But, you know, are they trying? Yeah. And their policies are certainly good. But if you don't spend money, enough money, the stimulus is just not going to work. And that's my worry. Paula Collins says, inheritance tax on the pension pot is a game changer. It certainly changes the application of the pension pot, but most people remember a pension is your pension. The reason why it's called a personal pension is that it's for your saving, not necessarily for your kids. So that's why I think, yeah, I don't have an issue with it, with inheritance tax on pensions. Graham Osborne says, do you think it's a good time to buy long-dated gilts? No. I'm quite upset about that because I was hoping there'd be a big gilt sell-off, but then Rachel Reeves, she has her fiscal rules and the gilt market hardly reacts at all. So no bargains, and I'm very disappointed. So is it attractive right now? I don't think so. If you compare it with something like a money market fund, currently you get 4.95% with a money market fund because of SONIA, the Sterling Overnight Index average rate, 4.95. Whereas if you look at the UK yield curve, let's use the FT for that. You can see that at the moment it's just not attractive because the yield curve is just not very high at all relative to money markets. So markets data, and I'll pull up the bonds, the bond yield curve. Oops. Bonds, here we go. Yeah, there's a glitch here. So the 1 month rate a month ago was not 6.92%. But you can see that overall yields have been kind of moving up in the belly. So we've gone from 3.9 up to 4.2. But it's still not very attractive. Even at the short end, 4.95 is what you get with the money market funds. So still not quite there. And that's at the short end, of course, it's going to be falling. That's what we've been seeing. And the curve's kind of gone from inverted to slightly less inverted. And presumably it'll completely uninvert as monetary policy normalizes. But at the moment, there's just not much term premium. You're not being paid to take duration risk. So that's why I think it's unattractive right now. But there will be opportunities later on. There could be an accident later on, and that could make gilts spike, hopefully. How are we doing for time? Okay, 4 minutes. One more question, let's say. Bob says, "Hey Roman, in this episode's thumbnail, are you mirroring Rachel Reeves's glumness? God made me that way. I just look glum. That's my resting Roman face, I'm afraid." David says, "The value of gold today is the same as 10 years ago when adjusted for inflation." Yeah. The risk premium for gold is zero. You just earn. Roughly, it keeps track with inflation, which makes sense. Jay says, "Gold isn't risky, it's a risk hedge. Gold miners remain risky given market irrationality in respect of history." Yeah, so if you buy gold miners, you earn the risk premium. The reason for that is that they are risky. They have an additional risk on top of gold, which is that if the equity market falls, the gold miners will fall as well. But if you hold them long term, you earn the risk premium, you get the dividend, and you get correlation with gold. So, yeah, it's just another way to get the exposure. But if it's just a hedge that you want against stocks falling or primarily stocks falling, yeah, you wouldn't hold gold miners. And one more. What about the spring budget? Adrian Carr says, "How likely is it she'll mess with tax relief on putting money into pensions or putting a cap on ISA savings?" Unlikely, I think, because remember what they're not trying to do is to stop people saving. Because if they do that, then ultimately the people who don't save in old age will be dependent on the state. So that could cost more in the long run. So I think it's unlikely they're going to fiddle with that and stop people saving and investing. So I think, they didn't go for things like the British ISA, which I think was a relief, because I don't think the government should determine where we invest. I just don't think that's their job. I think we should invest to get the best possible returns. But the overall, I think that overall. Okay. Zero Runny says, "Roman is a lefty disguised as a capitalist." Yeah, well, I kind of do believe in social justice. I think that the rich should look after the poor. I think that the job of any society is that it should do that. But I think capitalism's great. I'm a card-carrying member of the capitalist club. So, I think that you can have capitalism with compassion. That's just the way I see things. Oh, we've got one more super chat, which I will answer, and then we'll finish. How the NIN employer and impacts outside IR35 and limited. How the NIN employer. I'm not sure what that means. I think what you mean is, how do national insurance contributions impact outside IR35 and limited companies? Is that what you mean? So I think the national insurance. Oh, Laura's chatting something. Oh, there's a spelling. How the NI employ. Let me see if I can find the actual comment in YouTube. Yeah. NIN tax increment for employers. It's not something I'm aware of. Nope, I'm not sure what you mean. Do you mean national insurance? Yes. Okay. Well, the overall effect of national insurance is, at least according to the OBR, is that it's going to make it more expensive to hire staff as employees. I guess you could argue that if you hire people as contractors, then you're not going to have to pay NI contributions, so it costs you less. So perhaps it'll favour contract employees rather than full-time employees. So perhaps that's one of the unintended consequences of this change. But if you are a solopreneur, and we're not far off it here in PensionCraft, which is that we do pay ourselves with dividends, and the NI break is a kind of positive one for us. We don't have to pay NI on our pension contributions, for example. So if we pay ourselves into our pension, that's very tax efficient, and that's not going to change because the employers are not going to have to pay NI on pension contributions. That's one of the things which people thought that Rachel Reeves might do, but she didn't do. So there are still fairly tax efficient ways to pay yourself if you are a small company. Laura is trying to write something for me here. Not on dividend, but on our pay as you earn, she's saying. We should just get her on the call. I should just summon her upstairs so she can explain it. Anyway, so not on dividends, but we pay as you earn. There we go. Right. I'm afraid I didn't answer your question very well because I'm not sure I understood it. But yeah, I'm sorry about that. Rare. Oh, he did say awesome, thank you. ConCon MCMC said outside IR35, a limited company owners, single shareholder for contracting. And limited company owners outside IR35 don't normally pay with salary. So there we are. Someone else answered for me. Brilliant. And Rare says awesome, thank you. Okay, well, he got an answer, but not from me. Brilliant. So on that note, remember that if you do join our community, they'll also answer your questions better than I can. So if you do want to join us, just go to pensioncraft.com/membership. Do like and subscribe for this video. And also thank you for joining us, spending an hour with us to talk about the budget. And we will be covering the Fed, the Bank of England shortly. So do join us for that. In fact, I think we've got a double day, which is like 2 central bank live streams on the same day. One at lunchtime for the Bank of England and one in the evening for the Fed, which is a first, I think possibly because of the election. So do join us for that and like and subscribe, look at our community, listen to our podcast. And don't forget that you can listen to our podcast on YouTube now. Just go to youtube.com/ Many Happy Returns podcast. So it's youtube.com/ Many Happy Returns podcast, all one word. And that way you can listen to our podcast on YouTube. So please do join us on there. We've got just over 1,000 subscribers on there, so that is building up over time, and maybe we'll do video on there one day as well. So thank you all for joining us, and I hope you didn't lose too much in the budget and that it didn't affect you negatively, and let's hope that it does generate some growth, because after all, that's what it was designed to do. Take care, everyone. Bye bye.